We are live across streaming platforms. Looks like we have found an initial bottom at 435, and we're seeing rates in the 30-year, for example, move up markedly, 2% up as far as the number goes, but basically we move from 4.48% to 4.6%. So a tenth of a percent and a little bit of change. I mean, I'm happy about it if I'm hedged. I've got my rates hedged, and then I've got my portfolio hedged. So the move down in my securities is hedged. The move up in rates, which would decrease the value, the face value of my bonds, is hedged. So I'm looking pretty. I mean, I'm just, riding all this out. And if rates do get up to maybe 4.75%, I'll take a nibble. I'm going to add some. If they get up to 4.9%, I'll add some. If they hit 4.95%, I'll add some. And then at 5, I will most definitely add some. And I would even be happy there. If they went higher and I didn't even add some. I mean, 5%, that's great. 30-year bonds, I'm sitting on 30-year bonds. I can sell them or not. But if rates were to go down to 2% or even 0% if there was an economic crash, the Fed usually will lower rates, then that money that I have in those bonds will double, maybe even triple, because I've got the 30 years at 5%, so 5 times 30 is 150%. So that means that you have your original value of your capital, and then you have the future value of the bond, which is more than the original value of the capital, as the total value of that bond. And so if rates go to 0, people will have to get your bond for its new future, part of its new future payout value. And so that would be more than a double. It should be like 1.3% or something like that. I mean, 1.3x. So you would 1.3x your capital. So yeah, that's what I'm doing. And in the meantime, I'm getting the 5% or whatever, 4.5%. Mine are at like 4.2% on average. I've bought all up and down the spectrum, and I'll buy more. So I am not concerned about higher rates. I'm happy about them. And but if you have any problems in your portfolio, let me know, and I'm happy to help you figure it out. But you want to watch out for these moments, and you want to hedge what you got in moments like this, not just moments like this morning with CPI and Fed and then PPI, but moments where rates have been running away. Good morning, Tony. Where rates have been running away from us. Like if we go over here to the 30-year, you can see they've been increasing on higher highs and higher lows for a little while now. They're slowing a little bit, but today has added some fuel to the fire. Here's how they look as far as how you can see that they're slowing. So you had lower low here, and then you had a high, which turned out to be higher high. And this one inched higher. We'll call it a higher high. But this is where it slowed. It didn't really get to a higher high until here. This doesn't count, you know? So you don't zigzag that up in your pivot points when you're drawing these out. And so the wave has slowed. The distance here to here, at least today, and things could change, but that could just make it even more distant, is less than the distance from there to there and from here to here. So the frequency of which it's making higher highs has slowed. Today's information could change that. It could go on a rampage. We could get all the way up to 4.9 from here. We could go on a run for until May to 4.9. And then when it pulls back, let's say to 4.6, and then starts moving again and makes a new high. And at that point, what I'm saying is the frequency would be fast again. So the momentum would be building. So this would be slow area, and then this would be fast. So I mean, until June, we don't really know. Can't really know, but I'm watching it every day. I'm looking at these charts every day. But rates are what is this big force out there that's sort of controlling society, like with the puppet master strings, the that's what it's controlling. It's controlling rates. And how the 30-year responds and the 10-year, the 2-year, the 1-year, they all respond similarly as far as the waves and going up or going down, and how they respond is reflective of how the Fed is manipulating things. And then higher rates puts pressure on growth markets. So you see the QQQ has been slowing as rates have been going up. The momentum has been slowing over there as well. You can see that in how, for example, the distance that we're getting off of the 50 moving average was strong, and then not suddenly, but it started to be less and less strong as we got into March, and the distances have gotten shorter and shorter, and now they're non-existent. Higher highs, and we are going to open for the first time below. For the first time, we're going to open below the 50 moving average through that green line. And so this might set us back for a while. Let me get my chart moved off to the right. But we had that, look at the white line, maybe if that helps. But if you could just look at the candlesticks and how they are starting to curve, we had that slowing of momentum. And that, can happen. And we may be until November 5th, I believe is the election. We maybe won't see another high, another all-time high until after the election, which is, roughly around there. So this whole region here, is up for grabs as far as how far, if it just wants to go on a continuous downtrend, it would look something like that. But by the way, I don't think that's what's going to happen at all. I'm just showing you that's the room. Like that could be the worst it gets outside of, if the Fed fucks up, and decides to raise rates too aggressively coming up here. I do believe that it has room to raise rates another quarter basis point without affecting GDP growth and unemployment, layoffs, bankruptcies, foreclosures. I think the economy is doing just fine at 3.4% GDP right now. That's a great number to do. We really only need to do 2.25 or 2% GDP every year in order to have a strong, robust, growing economy. We only need 2%. We're at 3.4%. We are raging. Like, this economy is just doing fantastic. We're about to enter an earnings cycle, so we're going to start to hear back from the companies as far as how have revenues been. That's demand, spending, revenues coming in, spending that's out there, right? Stimulation of demand for services and products. And then we're going to see, are they still managing their company efficiently? And I'm going to guess yes. And probably they're even battening down more hatches and becoming more efficient because it's not a time to be, what's the word, frivolous with how you run your company. It's a time to be very careful and run things very efficiently. And that's what's helping produce such great GDP growth, by the way. And so that's going to cause bottom line profits to be sustained and to be there. So I believe, but we shall see. I believe that this next season of ER releases over the next 6 weeks, which we've just started, we started with the banks this week. I believe those are all going to point to good direction. I don't think we're going to see any surprises there. Everything's going to be a-okay. And so, although we'll have, the inflation beast on our back, which, by the way, inflation is flat. Inflation is flat from the prior numbers. It's roughly flat. So, when we get to the top of inflation, it doesn't have to be like a beam, a flat beam across. It can kind of go like this, then even spike and then come down and then dip and then just like a stock. But consolidation or sideways or stage three topping has room for wiggle room, and yet, so you can't really freak out too much about, economically when it comes to the economy, about little blips, little tiny little bubbles, little ripples on a basically calm lake. It's not going anywhere. So I do believe that we could actually take another rate increase. And I think you won't speak about that in the next, tonight, today. Uh, the Fed report won't talk about that, or Jay Powell won't speak about that today in today's report at 2 p.m. But that in the next couple months, there might be a word about that because the economy is just doing so good. It could just take a hit. It could just take a hit to the rib cage, as I said. So, if the Fed were to raise a quarter point on interest rates, it would add a micron of pressure, and it wouldn't cause layoffs, bankruptcies, foreclosure. I think it's got room for that. And what that would do is it would uh, add enough additional pressure to help quell inflation fears and inflation itself. And so be watching for that in the coming weeks. So what I think could happen here, we're set to open right around here today, by the way. So this line's going to be like this. Is, maybe we do break down a little bit some of these prior pivots. Maybe we get a breakdown, we get a corrective. Look at this one back here. Look at this stage three back here, the stage three consolidation. It was downward sloping. And we could get something like that again. We could get a halfway downward sloping consolidation region down here. Something like this could happen. And then election happens right here. And we continue on in society as normal. And we hit all-time new highs, new all-time highs, New Year's Eve, roughly, or, in January, December, we have Santa Claus rally. The whole period is always, it's seasonal. But in election years, we do tend to go flat after March and pull back and have kind of a rough summer. And there's usually room for like two rallies, like this one here, a nice rally off of low, but they're going to be extremely difficult to pick out and catch. So, stick with me though. I'll try to point them out, and we'll try to grab some of that. But all right, we've got 13 minutes before the market opens, and I think that that's what we're really looking at ahead of us. And it's always important to think about these things in your trading, whether you're a day trader or a swing trader. And if you're an investor, it's less important because you should just continue to be investing. But as a trader of of any kind, you need to know the macro. You need to know your economics. You need to know the GDP, the CPI, how this all works together. One of the books you could get on some of this stuff to help learn more is this one. Where do we have it? Right here, Mastering the Market Cycle by Howard Marks. If you are going to pick that up, let me know. Send me a little message or drop a line in the group, and I'll get you my Amazon, what do they call it? Affiliate link. And then that way I'll make $2 off your purchase. What does that matter? Well, by the end of the year, after enough of those happen, I've got $20, $40, 50, but whatever it is, and I can then buy myself a new book. So that's what I do with that, and that's always appreciated. But if you don't want to give me $2, fine, fuck you, and get the book though. Make sure you grab that book. It's really great. Howard Marks, Mastering the Market Cycle, and you'll learn all about those cycles. There's also a good real estate book. Where is that? I might have it here. A real estate book on the real estate cycles, which talks similarly about cycles. But anyway, you want to learn your cycles, and they're all based on the Fed's rates and GDP and inflation. They all work together and they create these like 12-year cycles, um, and then bear markets for 1 to 2 years, and you got to learn that. So you have to take a look every day at the market to see where are we? Are we in a spot where we could pop and start to rally? Are we in a spot that's crunchy and we're going to have to sit for a while? Well, that's going to affect your exposure. You've got to learn how to sit out and sideline during unprofitable times because you'll just trade it all back. You'll just bleed it all back out in tiny little cuts. You have to know how to sit out during the right moments. Well, especially if you're trading shares. We use theta, so sideways for us is excellent. But that's for those of you who are doing the credit spread system. We're good there. But yesterday, knowing that CPI was coming and that things could get crazy, I hedged my portfolio by grabbing as many QQQ puts as would cover how much beta weighted delta QQQ deltas I have and hold in my portfolio of tickers of equities. And so, you can learn about, we could talk about that more on Thursday night if you like in master class. We've done that several times, and you can learn more in my market mastery under beta weighted delta hedging. But I'll be up how much I'm down this morning. That's hedging. And so I just wait this out. I'll just wait this out, and theta will come in either way. But I don't think we'll see how the market responds, but I don't think that there's buying allocation, capital, risk on type of environment right now, at least until all this is behind us. And I mean by all this is just CPI, the Fed at 2 p.m., and PPI tomorrow morning. Once all that's behind us, it still may take a few days, even a week, to digest all that. And in the meantime, those ER reports are going to start coming out. So, maybe we stay negative and we stay red and we bleed out for the next week and a half until Amazon's earnings come in, until Apple's earnings come in, until Microsoft, until all that starts happening. This whole month of April could be choppy and difficult to pick bottoms on, but then perhaps we'll be able to get into something on a whole in May or June. In the meantime, we just got to watch. I will see how things are going to be reacting here from the open, because that's important. If we're opening lower, gap opening lower, and we move up and we reclaim the lows of yesterday, that can be an entry signal. But also watch out if you start getting into something because of the entry signals. Um, it's probably the right decision, but at the same time, be prepared to ditch that decision if the whole thing U-turns on us and we start going more red. We'll know more in 7 minutes once the market opens. And as Carl has said, triple fuckery has begun. And by that we mean CPI, Fed report later today, and PPI in the morning tomorrow. Triple triple fuckery. Rate cut for July down to 38% probability. Yeah, uh, that is that makes sense. Anyway, let's see what we've got, if anything, popping this morning at all. I doubt there's anything useful. Got a 50-cent stock, $1.72, a 12-cent stock, $1.04, $1.92, $1.33. Nothing of value. We got ARQ, which is a $7.40 stock worth a quarter of a billion, uh, up 9%, almost 10%. Let's just take a look at that and see if this is not a penny stock. Oh, it's a penny stock. So this was $1.74 a couple months ago. It recently popped and has been crazy since this last ER. And I guess that does look like it is profitable, and it's sporting about an 11% margin. The revs are up, so the demand for their product or service is up. And this has been the first time they've been profitable in 2.5 years, roughly. ARQ. Now, what do they do? Let's see. It's a holding company. That usually means that it's just an umbrella company for something here. Environmental and emission control equipment to the power generation industry. Is there a growing market for that? Yeah, I suppose there is. The company operates through the following segments: refined coal and advanced purification technologies. The refined coal segment includes Teenum Group, Teenum Services, and GWM. So if anybody knows what those are out there, comment below. The advanced purification technology segment refers to the sale of activated carbon injection and dry sorbent injection equipment systems, chemical sales, consulting services, and other. In any event, it has popped and moved 136% in 24 days, and to my eyes is still within a holy grail pullback. It's a pretty tight, tight flag, meaning there's still a lot more strength here, potentially, for it to run. So you penny stock traders, I know Carl, you love that. This ARQ could be one heck of a freshie for you to go after. I'm not going to trade it. It's not in the system of what I'm trading. But that looks like a great penny stocking opportunity for you. And that's about all there is pre-market of value. I'm checking this other list here. JAGX up 37%. JAGX, let me take a look at that. We got 3 minutes till the market opens. Nah, that just looks just terrible. 66% for WNW. Now that's penny stock. 17% for Verb. Okay, let's look at that. Verb Technology. God, no. Dead cat bouncing at best. Ideal. What's the market cap on that? 4 million. Yeah, that's ridiculous. Don't touch those, you guys. Leave that to Carl. Tony, make sure you come to class on Thursday night. We got to continue to get you up to speed and working things. Have you been doing anything? Have you been practicing? Use paper trading to try and practice, you guys, with the spreads. I know, Tony, you want to get your system going. All right, let's watch the market here. We've got 2 minutes before the open. And there- That 30-year elevated, yeah, I'm cool with that. It means I can get some bonds at 5% soon. Hell yes. So what do you guys have your eyes on? Anything else? I'm in about 40 positions, so I'll probably be checking the health of those as the market opens to see if there's anything that I need to be concerned about, whether to take profits or to uh, consider cutting. Tony says, "Have a great morning. Gotta go. All right, see you later, buddy. To fix some washers." Okay, see you Thursday class. That'd be great. 9 p.m. Eastern time. Later, Tony. All right. Watch yourselves on the market, guys. That's right. Schmo just said, going to be a boring ass year now unless we get downside trend. Well, that could come, but it's very hard to trade. Very hard to trade pullbacks, corrections. It's just very choppy. You're better off not trading. Eugene, how's it going, buddy? And the market is open. And we'll see how things move off of the open here in just a moment. So far, it's about 50-50. You may be hanging out here. Nah, it's a bit red. Overall, I'd say it's about 65% red, 35% green off the open. INSP still going. The market itself sideways right off the open here. INSP just keeps going. It doesn't care what's going on in the market. Yeah, I'd say we're still at almost a 50-50 mark direction wise on which way the market wants to go with this. I'm going to be checking some of my positions. Dell, I'm in Dell. I just want to make sure nothing's doing anything panicky. And SMCI. I mean, so far they're actually kind of recovering. All right. Yeah. Big caps now are about 75% green off of the open. So we are getting some recovery, it looks like. Oh, wow. GRMN is heading for the hills. I've got my stop loss. I got to get out of that. But I'm just going to give it another few minutes though. The market is going sideways, slightly up. Let's look at the S&P 500. It is also, well, off of the open, still red, but it looks like it wants to be green. And rates, let's go back and look at the rates, how they're responding. All right, mostly we're equalizing off of this change in price in rates and in the market. Look like, we're filling the gap a little bit here and equalizing. We'll have to see, a couple of pivot points. It could take about an hour and a half, really. I'm not going to be here that whole time. I'll be in the group though. But it might take about an hour and a half for us to get 4 points to a trend and figure out what's going on here a little bit, how the day is going to turn out. It looks like the market might attempt to make a new low here. On the off the open, but it's not the lowest prices that we've seen today. We've had lower prices in pre-market. Maybe it's finding some demand and some resilience and some support. Off of the open, I'm seeing like almost 85% green off of the open on our growth stocks. So that's a pretty positive for the day so far. That's an overall consensus that this is a buy the dip, especially on the growth opportunities, like DraftKings and stuff like that. I just dropped my hedge on the market based on some of that stuff that I was just talking about. I'll put it back on if we break down. But if we do not break down, then I have just dropped my hedge. And everything else will appreciate along with what seems to be supportive buy the dip outlook in the market right now. Yep, there we go. New highs for the day off the open on the market. And now we're sporting about a 90% green off the open. Wow, 95% green off of the open on the growth opportunities. Wow. This is just absolutely turned into a buy the dip. Pretty interesting. Pretty interesting. Leading the brigade is RVMD. Take a quick look at this swing trading perspective. Revolution Medicines. Okay, I don't like its bullishness. It's not very verified. But this is great. It is a great move today, especially if somebody was in it. I'd say, kudos to you. And it is a relative strength breakout, and it could be going somewhere. And if that stock's for you, then there it is. That's RVMD. I'm not going to touch it though. RVMD. And also, this SMCI is doing well off of the open. Okay. Yeah, this could turn out to be, this whole thing could turn out to be, like I said, a buy, a gap down. Why is it doing this? There we go. A gap down reclaim buy across the market. Now, I'd like that to be above Gamma, if so, which is 438 on the Qs. So once we get over 438 on the Qs, we might be in a very strong point to get in very early on. There it is. Boy, that came up fat. Woof. The market is really getting bought up here. Buying the dip is happening. If there are opportunities out there with signals on them and you're following them and you're stocking them, uh, then we got let me know what they are and I can help you through them. But like for instance, this one, Micron, see this blue bar here? Those are very rare dip reclaim entries, which work out a good fair bit of time, 75% of the time, to be excellent points of purchase and points of entry at great low prices. So this day so far has turned out to be a buying opportunity. The bull market rages on. We'll know more at 2 p.m. when the Fed speaks. Until then, I'll be in the group speaking. I'll see you there. Thanks for the morning, everybody. That's the market update. We'll stay on top of things and stay tuned. Appreciate you and see you in the group. All right. Have a good morning, everybody.